Hi everyone, we are Claudia Sanabria, Camila Molina, and Duarte, and we will briefly explain about the conceptual framework of financial information. Okay, in the International Accounting Standards Board used the revised version of Conceptual Framework for Financial Information. Now, what is the objective of this information? First, the qualitative characteristics of the information, rate of assets, liabilities, equity, income, and expenses. Criteria to include assets and liabilities in the financial statements and guidance on when to remove them. Measurement basis and guidance on using them. Chapter 1. The purpose of financial information. 1. Purpose of financial information. Provide financial information that is useful for users in decision making in relation to the provision of resources to the entity. Meet, register, and present the assets and resources and the property of an economic entity. Recognize the obligations which has to respond with those resources on their owners. To perform both evaluations, users need information about both the economic resource of the entity, claims against the entity. Chapter 2. Qualitative characteristics of tools financial information. For the accounting information to be of good quality, it must be clear and easy to understand, useful for meeting the objectives that are due, timely to take corrective actions and explore new possibilities, verifiable and faithful representative of the economic facts that can be compared with the consistent reports and phased over several periods.
Duarte, and I'm going to talk about financial statements and the reporting entity. Let's start. What is a reporting entity? Is an entity required or choose to prepare financial statements? But what is a financial statement? Financial statements are particular form of financial report that provide information that includes reporting entities, assets, liabilities, equity, income, and expenses. There are different types of financial statements. We can find consolidate, unconsolidate, and combined. Let's talk about consolidate. Consolidated financial statements provides information about assets, liability, equity, income, and expenses as a single reporting entity. That's why it's called consolidate. Then we can find an unconsolidated financial statement that provides information about assets, liabilities, equity, income, and expenses of the parent only. Then we can find finally, a combined financial statement provides information about assets, liabilities, equity, income, and expenses of two or more entities that are not all linked by a parent-subsidiary relationship. Then let's talk about some elements of financial statement. Let's start with asset. Asset is a resource controlled by the entity as a result of past events and from which future economic benefits are expected to flow to the entity. Then let's talk about liability. Liability is a present obligation of the entity to transfer an economic resource as a result of past events. Now let's talk about income. An income is money or some equivalent value that an individual or business person receives in exchange for providing a good or a service or through investing capital. In income, increase in assets or decrease in liabilities that result in increases in equity. And finally, let's talk about expenses. An expense is a cost of operation that a company incurs. Here, decrease in assets or increase in liabilities that result in the decreases of equity. Thank you so much.
Hi, my name is Maria Camila Molina, and I'm going to be talking about chapters 5, 6, and 7. Chapter 5 talks about recognition and derecognition. Recognition is when you classify an item as an asset, liability, equity, income, or expense that should be included in a financial statement. For an item to be recognized, it should be both relevant for the financial statement and you need to have a faithful representation of this item. For example, if you have an asset, are you sure that that asset still exists? And for a faithful representation, are you sure of the value of that asset? Now, derecognition is when you don't take into account all or part of an asset or a liability for a statement. How do you know if you should derecognize an item? For an asset, when you lose total or partial control over that asset, you should derecognize it. And for a liability, when you don't have any obligations over it anymore, you should recognize it. Why are important recognition and derecognition? Because this will let us know the actual profit of the company. Now, chapter 6, measurements. There are two types of measurement bases. Number 1 is historical cost measurement base, and number 2 is current value measurement basis. For historical cost measurement basis, the characteristics are that it gives information based on the price of the transaction or other relevant events related to the item. The historical cost of an asset is reduced if this asset is damaged or not useful anymore, and the cost of a liability, the historical cost of a liability, grows if it becomes too much of a burden for the company. Finally, to apply a historical cost base, we need to measure the assets and liabilities at amortized cost, which means that you need to take some value off depending on each year that the asset has been with the company and how old it is. Now, for current value measurement basis, the current value measurement basis gives you information for current conditions of an asset or a liability. It includes the fair value, which is how much you were to receive today. Let's say we're doing this today, how much you were to receive today for the asset, or how much you will have to pay today for that liability. It reflects on the current value of that asset or liability in the market. Then we have value in use for assets and for liabilities, how much has been paid. This shows the actual value of that asset or liability in the company. And finally, we have the current cost. The current cost is how much you will have to pay or how much you will receive for an equivalent asset or liability right now in the market. What do you need to consider when you want to choose a measurement instrument? We have two characteristics. One is relevance again, and then we have faithful representation, and it's very similar than in last chapter. Relevant gives you characteristics of this item. So, for example, how much does it affect the cash flow, and how sensitive is it to the market? How sensitive that asset or liability is to the market factors, and how much it contributes to future cash flows. And then we have the faithful representation, which is again if you have measurements inconsistency or measurement uncertainties, you should not include you should not use these the measurement basis. And finally, we have the 7th chapter, which talks about presentation and disclosure. So it talks about the statements of profit loss. As statement of profit or losses is the primary source of information regarding the company's financial execution in a determined time period. A profit or loss can be included in other financial statements or have a particular by itself a statement of their own, but the statement of financial performance will always include the total or subtotal of profits or losses. And finally, for the statements, all incomes are for the statement of profit or losses, all incomes expenses should be included. And now we're going to talk about other comprehensive incomes and recycling. In what are other comprehensive incomes? So in some specific situations, the board might decide that an income or an expense resulting from a change of value in an asset or liability should not be included in the statement of profit or loss. So in this case, it will be included in our other comprehensive incomes. What happens to those values in other comprehensive incomes? So that's when recycling comes in. The other comprehensive incomes will be recycled in future statements or profit or losses, as long as they will provide more relevant information and more faithful representation of the information that we already have. If they do not, then the board might decide they should not be recycled anymore in the future. Thank you.